Good evening, traders. This is FX RBS with ForexSimplified.com, and we're with the Monday daily Monday class. Tonight we're going to talk a little bit about head and shoulders and how we can use head and shoulders together with different patterns, 2 points, some trend reversals, and how is the best way to enter those nice patterns. First, I will explain what the head and shoulders is. Maybe most of you guys know what the head and shoulder is. I will show you tonight how I'm trading those patterns and how I converge them with butterflies or garters. So basically, let's say price is in a downtrend and price is making lower lows and lower highs. At some point when price is ready to reverse, the first thing we're going to see is that price will most likely break the trend line. So we have price going down, making lower lows and lower highs, trading close to the trend line. The first thing we are going to see is price breaking this trend line. Now once price breaks the trend line, the next thing that will signal for us that price is changing direction is maybe we'll make higher high. Price will no longer continue to make lower lows and lower highs, but now price will start making higher highs and probably higher lows. Now first thing that we're seeing is the trend line break, and sometimes you'll see price take the previous high. A lot of times when we have head and shoulders formed, the new high might form at the same level as the last one. This is still a valid head and shoulders pattern. Now, next thing we can do, there is a couple of ways to trade head and shoulders pattern. Now, some traders use so-called right shoulder to enter the market. Now we have left shoulder, right shoulder, and we have the head in the middle. Let me make the font larger. So we have the left shoulder, we have the head, we have also the right shoulder. Once we have the trend line broken, we have a high near the previous high or maybe higher. And the next thing is that price is going to retest that left shoulder. And a lot of times we'll actually see price hit the backside of this trend line near the left shoulder level. And what it does is finding support from the level coming from the left shoulder, as well finding support of the backside of the trend line. So some traders will trade this level, the right shoulder, and they will enter long. Now the next group of traders, they like to see a break of the neckline. Now here the line between the two highs is called the neckline. Once price starts moving north, breaking of this neckline confirms additionally that price is reversing and now is going to move further bullish, and a lot of people use the break of the neckline for bullish entries. So what we can have is buy one at the right shoulder, and then the second group is at the neckline. So again, what we have here is a downtrend line, market making lower lows, lower highs, then price is breaking the trend line, taking the previous high, coming back to retest the left shoulder. A lot of times this retest occurs at the trend line, the backside of the trend line. Here is where we enter the market. Some traders will enter the market when price breaks the neckline. Both those strategies are good, valid. I can't say which one's better. I prefer entering at the right shoulder, personally. Now, how do I use head and shoulders with other patterns? This is what I told you guys in the beginning of this session, that I will show you how to converge head and shoulders with different patterns. Let me read over the questions real quick. The question is that Rodney is asking, he's heard that if the right shoulder is lower than the left shoulder, the head and shoulders is most likely to fail. If Rodney means something like this here, is it something like this, Rodney, if we have the right shoulder leveled like this, angled? If it goes lower. So Rodney is saying that if it goes lower than the left shoulder, like this, if it takes it. Now, I also don't like trading head and shoulders that look like this. I would prefer a lot better if this right shoulder actually comes all the way down to the level of the head. Now, this here is not anymore head and shoulders. This will be a double bottom. But a pattern like this will give us a lot higher probability than if the right shoulder is lower than the left shoulder. And yes, Rodney, you're right. If head and shoulders look something like this, it has higher chance of failing. Now, sometimes the right shoulder is higher than the left shoulder. Now, this doesn't have lower probability of working out. The only thing that we see here is that the trend is trying to reverse too fast, and price cannot drop as much as the left shoulder. traders are taking in positions earlier, and this is actually sometimes a signal that price will rally fast. There is another pattern close to the head and shoulders. It is called 5-0. It's a little more complex than the head and shoulders, where the 5-0 shows exactly that the reversal is happening too fast. Too many traders are changing position, and the market will rally fast. Now let me show you an example of how I like to use different patterns together with the head and shoulders to confirm entries. I will go here to the left, and I will show you this head and shoulders. Now this is a weekly chart. Yes, the JPY weekly chart. We have the left shoulder and the right shoulder formed at exactly the same level as the left shoulder. Now if you would like to enter trade like this, most of the traders, when they're trading head and shoulders, if they enter at the right shoulder, they would place stop below the head. Now here on the weekly chart, it's pretty much impossible for us to place the stop below the head because we need like anywhere between 300 and 400 pip stop. This is for some traders might be too much. Now another indication of price reversal is also this MACD divergence. That's showing us that yes, there might be a trend reversal. And what I do is, once I notice head and shoulders on higher time frame, like weekly, it might be a daily chart or 4-hour chart. Now what I do is, as we get close to the level, now we're forming the left shoulder, the head, we're taking the previous high. And now here, at this point, once we take the previous high and when price starts moving lower, now we can start thinking about head and shoulders because now we can actually recognize it. Now the chart will look something like this. I will hide some of those candles. Now we'll notice the MACD divergence here. Price will start going up. We'll take the previous high, talking about this high here. And then we'll start making those lower candles going towards the left shoulder level. And as we get close, I would start looking for patterns converging with the right shoulder. Now, I will be targeting levels around 88.00, 88.20 on a smaller time frame. Smaller time frame, I mean like 1 hour, maybe 15 minutes. And I will start looking for bullish patterns, any bullish pattern that we can converge with that level, 88.00, 88.20. Now in this particular case, probably I won't be able to go that much back in the charts. Let me see when it was that. But we had bullish crab on a 15-minute time frame, I believe. But my point is, once we know that level of 88.20, we go to a 15-minute time frame or 1 hour time frame. Now, compared to the weekly, this is very small time frame. So we can go to a 1 hour or maybe 2 hour time frame, looking for another pattern. And this leg from the top that took the previous high to the right shoulder on a 1 hour chart, how this leg will look like a downtrend. So what kind of pattern would we look for on a 1 hour time frame in a downtrend to converge with this level? Since this leg looks like a downtrend, and we anticipate that price will start making higher highs after hitting that 88 level, now we need to look for a reversal pattern, because we've been in a downtrend. Now we're only talking about this leg from the high to the low, because this is what we're going to be seeing only on a 1 hour or the 2 hour time frame. So we'll be looking for reversal patterns. Reversal patterns are butterfly, crab, and other head and shoulders. We can easily find a smaller head and shoulders in a small time frame converging with the right shoulder. Now, it will look, if I can go here, I will try to draw it in one chart. It might look something like this. Where we have this big head and shoulders, and then in that leg going down, we have a smaller one with a left shoulder here and then a right shoulder here. I'm sorry, I probably didn't draw it very pretty, but I hope you guys can see the small head and shoulders inside the big one. Or if not a small head and shoulders, it can be another reversal pattern. It can be a butterfly. That will form at the right shoulder. Now, of course, like Victor is saying, if we can use a candlestick formation, yes, candlestick formation can be used, but the way we use candlestick formation, the candlestick formation need to be on a time frame, like either the same time frame or maybe time frame that's a little too, just a little smaller. Like if we go from, if we have a pattern on a 1 hour time frame, sometimes we can use a candlestick formation from a 15-minute. Now, if we have a pattern on a weekly time frame, we can't use a 15-minute candlestick formation. We need something bigger. Now, if we use candlestick formation on a weekly time frame, that candlestick formation is still going to be very large and will have us trade large stop. Even if the candlestick formation is a morning star engulfing bullish candle on a daily time frame, still this candle might be a couple hundred pips. So this is why I'm trying to converge a entire pattern on a smaller time frame to that same level, and this is confirming the entire trade a lot better. Now, I use mostly this big pattern for like trend direction. It's not that I only trade the pattern, but once we form the right shoulder, we know that we'll be in an uptrend at least here to the neckline. If we have a neckline coming up somewhere at the high of this previous high, we know that for the next 600 pips, we're most likely in a straight uptrend. And after we know that for the next 600 pips, we're in an uptrend, we're going to be trading all bullish patterns during those 600 pips. Now, from the right shoulder all the way here to the previous high, I would be trading bullish Gartleys. If I see somewhere a bullish Gartley, I will trade it bullish, and I know that, okay, all the way here to, what is that level, 94, I believe, 93.50, 94, I can be easily trading bullish patterns. And I will go to 1 hour time frame anytime the 1 hour time frame gives me a bullish pattern, bullish Gartley, I will take it, and this right shoulder confirms that the trend is bullish. Of course, the head and shoulders can fail, but it's still going to have at least a little bounce. Even if the pattern on such a big scale fails, on a smaller time frame, we'll have a large move. Let's say price comes back, retests that trend line, and continues to move bearish, and the pattern fails. Oh, look at this. The price bounced 400 pips. We can use at least those 400 pips to trade bullish, and we know that price will be trading bullish at least this much, and price actually did a lot more, and it might go even higher. Now, if there is questions if we should be exiting at those 600 pips. Now, if you can hold a trade for 600 pips, why not? The thing is that the way you can trade, the way you can stay in a trade for 600 pips is, and not hurt your emotions, as if you scale this trade out. You need to have different limits. You need to have limits all the way to the top of those 600 pips, or otherwise it will be very, very hard for us to stay in that trade, because we'll see our pips go to like +2, maybe +300, then go back to 100, and it will be this roller coaster if you take profits every once in a while, you won't think of, okay, should I stay or should I cash out? Now another thing is that some people might not have the money in their account to put that many limits. Like a lot of times I tell people, okay, if you want to put a lot of orders, a lot of limits, you need to just to place smaller sizes on each of those limits. If you're usually trading, let's say, standard lots, okay, then trade minis and place a lot of minis over all those 600 pips. Now, another thing that we can do is not just enter at the right shoulder aiming those 600 pips, but as I said, we go to a smaller time frame, we find us, let's say, a bullish crab, enter the bullish crab, use limits according to the bullish crab. Once we're finished with the bullish crab, we're going to wait for a pullback, and if price gives us another entry, let's say bullish Gartley or maybe bullish bat, and we'll enter again. We'll have a second entry with a different pattern, a different bullish pattern to take us up, and that bullish pattern maybe would stop us out, or it will work out good. If it works good, price moves higher, then we'll wait for a pullback. If it forms another pattern, we can take it. Not every time price will form patterns. A lot of times we'll see price break resistance, come back to retest the resistance, and explode from the resistance that will be forming support in future. And it will look something like this. We make higher highs, price breaks the resistance, comes back, retest that resistance, and continues in a continuing in a bullish move. Now sometimes, even though we have this resistance becoming support, price will even drop lower to form another bullish Gartley or a bullish bat, and then continues to move bullish. Now, if for some reason price finds very strong resistance, well, then price might continue on trading bearish. Now we can see that price have found very, very strong resistance level here. All those candles, those are weekly candles, are stopping here at this level. Price can't move above 95. And we can see price broke the trend line, came back to retest the trend line, tried to move above the resistance, it couldn't. Then a couple of Thursdays back, we had this crash, blamed on a computer mistake. Price moved a few hundred pips, came back. Now it's trading in this range between the trend line and the resistance. Now a lot of times when price forms head and shoulders, and I enter, I like to take my profit before the neckline, because most likely the neckline is the place where the pattern will fail if it fails. And this is why this next group of traders trading the neckline, they enter on a break of the neckline. Now we can see that here this black line can represent the neckline. We have previous highs. This is very, very strong resistance. Now if we're continuing to trade this pattern, we should trade it at least here to the 618 level. I will also use my expansion line to see if I have any convergences here. I have one close with the 127 with the 100, and then 1618 perfectly converging with 127 at the expansion line, meaning that the move after the right shoulder, or the CD move, is the AB times 127, and this is converging with 1618. This is very, very, very strong level here. And if price breaks above the neckline, probably this is where we're going to see the next stop, here around the 99-100 level. And this is why I said, when I'm trading head and shoulders, I like to take profit before the neckline, because the neckline can act as resistance. And then if I have more targets, I will trade all the way up to the extensions. Now here in this example, this is a weekly chart, and those are very large pips, huge moves that would require a lot of time. But you can see the same setup on a 4-hour time frame, and a 4-hour time frame will take a lot less time. Now you can use the 4-hour time frame and then converge that 4-hour head and shoulders with a bullish butterfly on a 15-minute time frame. And this bullish butterfly will again hit at the right shoulder. Now, also, we can see another trade setup, and I very, very like this trade setup. This is one of my favorite trade setups, and I need to delete some of those lines here. But what happens is, on its way up, when price is forming the right shoulder, we'll see a bullish Gartley form. And I see a lot of 786 with 127 Gartleys forming at the right shoulder. Now here we already took the previous high. Now we know that price is maybe in a bullish trend, reversing from bearish move. Now we're in a bullish trend. We expect price to start moving bullish, and here in this case we can start using those Gartleys. Now this is the first time we can enter on a bullish Gartley after the reversal, because we know that Gartleys and bats are continuation patterns, meaning that we can trade them with the trend. So here on a way down, when price was forming lower lows and lower highs, we could trade bearish butterflies, bearish bats and bearish Gartleys. Now on its way up, we can trade bullish Gartleys and bullish bats. And a lot of times I see Gartleys formed at the right shoulder. This gives us very, very high probability. We have 786 with 127 convergence at the level of the left shoulder. Very, very strong pattern. Does any of you guys have any questions right now? Okay, let's continue. I will also give you an example of another way I like to trade those bullish patterns. I mean those head and shoulders patterns is now we know head and shoulder is reversal pattern, so is butterfly and crab. Now you won't see this very often, this is more rare but very powerful. Now we need to have some kind of reason to believe that price will change direction at this level. Maybe from a previous support, or maybe bigger swing that has fib level at this price level here. But what we can see is price form bullish butterfly. Now here still we have no idea that price will form head and shoulders. This is pure butterfly. So price forms a butterfly, takes the A. So we have A, B, C, D. I will draw those smaller so they can fit here. So price will take the A, and here once price takes the A and price starts moving lower, we now can actually recognize that price formed by D for the butterfly at the head level, and we recognize that the left shoulder is the X, and maybe we can form right shoulder at that same level here. You can see sometimes price form a butterfly at the head. This would be a very, very good trade. Butterfly had reversed the price, then we have retest of the left shoulder and bullish continuation. How are you guys doing? Any questions so far? So just to refresh, head and shoulders is a reversal pattern. We need to take the trend line, the previous high, if it's a bullish head and shoulders, So that means that price has been trading bearish before that. Price has been forming lower lows, lower highs. Then with price breaks the trend line, starts making higher highs and higher lows, we can converge bullish Gartley or a bat at the right shoulder. Sometimes we can see a bullish butterfly form at the head of the head and shoulders pattern. We need to place some of our limits before the neckline. The stop goes below the head, and then next limit as we pull a fab from the head to the high. We see what pullback we have, and based on the pullback and where the right shoulder was formed, then we place the second limit. During this bullish move, we'll be looking for other bullish patterns on smaller time frames. Bullish Gartleys, bullish bats, all different bullish patterns, because we know that price is most likely to move at least to the neckline. And then if we see neckline break, we know that price will be trading higher. Thank you everyone for attending Monday's class. If you guys don't have any other questions, I will be closing the session today, and I will be more than glad to see you next Monday. If you guys have any questions, feel free to shoot me an email. You can always attach your charts. If you have questions on your charts, just attach your chart to the email, ask me questions about it, and I'll make sure I get back to you as soon as I can. Thank you guys, and I wish you all safe trading.